The objective of the Rainmaker Fund is multiple ultimate goals. The first is we're looking to grow the value of the assets, the capital value of the assets, ahead of inflation, and to generate positive returns for investors. We would like those returns. We aim to produce returns that are ahead of the fund's benchmark, which is the JSE All Share Index. And in addition to that, we want the fund to, on a reasonably consistent basis, to perform in the top quartile of its peer group of funds in the medium and long term. We describe our approach as bottom-up fundamental research stock pickers. We look for relatively cheap businesses doing relatively better growth in profits and dividends. We believe it's growth in profits and dividends that ultimately drives capital appreciation. We use that approach to build a portfolio where the size of the positions is a function of the conviction that we have on the underlying stocks, while at the same time not sitting complacently on those positions and watching the relative valuation, the absolute and relative valuation of the underlying companies, that on an ongoing basis, that even great businesses get relatively expensive, and we don't hesitate to use that opportunity to reduce the size of the position, and we would use those proceeds to rotate into something that, for whatever reason in the shorter term, may have been a relative underperformer. Constantly iterative as the approach refers to the day-to-day approach. We don't manage the portfolio where we would meet, say, as a team once a month or once a quarter and then decide on what portfolio position should be and then implement those decisions. We work together constructively as a team sitting in a single room. Our process is not governed by meetings and gatherings when you can get the relevant people together in a room, because we're always there all together, constantly working, responding to information, responding to analysis that's being done, responding to price movements in stocks, and if necessary, implementing that through changes in size of positions in the portfolio. Naspers is a fascinating stock. It's really a unique thing, a unique animal, a unique kind of business that we are lucky to be able to get exposure to here in South Africa. Essentially, right now, as we sit here in May 2017, your view on Naspers is dictated by your view on Tencent, which is the business that they own 35% of in China. You need to have a very clear view on what you think the prospects are for Tencent. It's a big business. It's one of the biggest internet-based businesses in the world today. It has grown phenomenally. It trades at a reasonably expensive multiple based on its history and on an absolute basis. And so you need a high degree of conviction that it can continue to grow at the rate that the market is discounting. For the time being, we have confidence that that is the case, and I could spend half an hour or more just going through that detail, which we don't have the time this morning, but happy to do so. Suffice to say, at ABAX, we remain confident that Tencent can continue to grow, notwithstanding the size that it currently has, at a rate that is satisfactory in the context of its current rating. In addition to that, the business in what you access as Naspers, there are a variety of other businesses. Unfortunately, the market for the time being attributes no value to those. But as long-term investors, we are confident that that value will be unlocked at some point in the future. But it remains dominated for the time being by your view on Tencent, which I've explained. The last point to make is that it's actually at 19% this morning with the short-term run that we've had, the exposure in the fund, which we are the first to acknowledge is an extremely large position to hold in any one company, regardless of how confident you are in its long-term growth prospects. And as a consequence of which, over the course of the last 2 weeks, we have started to hedge the size of that position in the portfolios, where should it decline below a certain level, we will effectively not share in that downside, but equally so, should it continue to run, those shares will be called from us. So we're starting to put hedges on the position as the share price has risen. So on a net basis, while the absolute position is 19% on a net basis today. As at mid-May 2017, it's about 16.5%. Well, we don't avoid anything. We would guard against prejudice in our investment approach. Certainly there are certain companies that we will have more circumspection around owing to the volatility of the nature of their profit stream. The mining industry, particularly specific single line or single mineral mining businesses, are notoriously difficult to predict with any accuracy. So we won't preclude any sector, and our process is to take anything in the universe that is potentially available into account. Political developments in the banking sector are very, very closely allied. The cost of borrowing and interest rates, have and the market's perspective of how that's likely to change and impacted by political interference in the financial management of the country has an immediate impact. Unfortunately, the consequences of the recent developments have all been negative. The ratings downgrade, the shuffling of the finance ministers, the changes that have occurred at the Treasury are all very negative in that regard. So the share prices of the banks, which had started to recover very nicely into the fourth quarter of 2016 under the stability and the progress that Pravin Gordhan was made, have largely been unwound in the first quarter of this year. And you've seen that in the retracement of the share prices. They're not particularly exciting sector, but they do represent absolute and relative value for the time being, and the dividend yields we feel are very supportive. As a consequence, we have a relatively large position in banks currently, our preferred selection there being FirstRand, although we do own some Barclays in addition to that, and a little Standard Bank. And collectively, we're overweight domestic South African banks, based on the view that between now and the end of the year, with the progress that we see being made, albeit gradual, suggests to us for the time being that a slightly more positive political resolution relative to how the situation currently in May of 2017 is a little more likely. And in that context, while unexciting, the BA 900 returns were issued yesterday afternoon. Credit growth extension in South Africa is practically non-existent. So the outlook for growth is unexciting, but the valuations more than take that into account, we feel, currently. Recent portfolio changes. So the first point I'd make is, from our constantly iterative approach, we're always busy here and there, tweaking there, rotating at the margin on things that may even be core holdings, from things that have run a little bit into things that have lagged a little bit. So that's an ongoing process. But perhaps I can talk about two positions that we've recently increased quite substantially and that we haven't held for some time, that are large cap stocks that are typically held broadly across the industry. The first is Sasol, which we acquired in the fourth quarter of 2016, so a few months ago now, and we've had a reasonably nice bounce out of it to start off with. And the reason being, for the time being, Sasol's profit fortunes are closely tied to the rand price of oil. Now, the oil price is at a relatively low level. We don't have a dogmatic view that we think it's going back to $100 a barrel. We think that would be quite naive. But we think it's likely to be reasonably firm around the $50 a barrel level. And our view is that we expect the rand is more likely to weaken from the current levels than strengthen. We're actually quite surprised at the degree of short-term strength that the currency is exhibiting. What that means is, in addition to that, is in 2016, the company finally came clean on the full capex requirement for the Lake Charles ethane cracker plant that they're building, which is now 25% physically complete, but 75%, in fact that was a month or so ago, 75% contractually complete. So we think a lot of the risk around the completion of that contract has been eliminated, and add to that, they're not applying some revolutionary new chemical process around what they're trying to do. Putting all of this together, if you compare Sasol to the global oil and gas majors, and more particularly if you compare it to chemical feedstock producers, it's trading at a record, or it was in December, and still today is relatively inexpensive on these comparative valuation metrics, pretty cheap. And as a consequence of which, we think the business is likely to re-rate over the course of the next few years as Lake Charles comes on stream and reaches full production, and that the market starts to appreciate that it's less of a pure oil and gas play and more of a combination oil and gas and chemicals producer, which typically trade at higher ratings. And so we've accumulated a position of around 6% on the view that that's what's more likely to materialize. Of course, being essentially a commodity-based business, it's not something that one can rest on your laurels on, and one needs to be constantly aware of any things that substantially may be changing that affect our view, for example, on the oil price. The second one, if you'd like me to comment, is MTN. Again, not a high-quality business. It's been, we feel, a poorly run business, scored plenty of own goals, has had particular issues where they have a highly profitable business in Nigeria. But a lot of this has come through in the price. I think the price peaked at over 200 Rand a share. It's been languishing around 120. In the meantime, circumstances in Nigeria, which, don't get me wrong, we're not expecting some miraculous recovery in the Nigerian economy or some miraculous improvement in governance standards with the regulator and whatever else is going on in Nigeria. But we note with interest that the currency, or the two-way currency, has actually, the black market currency has strengthened quite substantially closer to the official rate, that the Nigerian banks have started to recover, that the relationship with the regulator is improving, that there has been a lot of changes at senior management level, more importantly a chief executive who comes from a telco background, more importantly has worked for a firm that runs an outstanding business and really are on top of their game. The Iranian business, which is now the third biggest component, also continues to go from strength to strength, and a colleague of mine has recently been there to visit the country to establish that. And in South Africa, while certainly we don't see a miraculous turnaround, and they're likely to continue to lose market share to a more competent competitor in the form of Vodacom, we think ultimately that doesn't continue forever, while the share price continues to languish at a very low level. So while not the kind of high quality business that we would look for as a long-term holding in the portfolios, while we've owned no shares in the company for a long period of time, which has proven right, we think on a balance of probabilities way of thinking that it makes sense for us to rather own some in the relatively short term. And as a consequence from owning no shares today, we've accumulated a position of about 3%.